Income Tax 2020. Itemized Deductions Schedule A Overview. Come in, relax with Income Tax 2020. Itemized Deduction Schedule A Overview. When thinking about our income tax equation, we're going to be down here in the itemized deductions, one of what we could refer to as the below the line deductions, remembering that our income tax equation can basically be broken out into two parts, the top part being a modified income statement, the bottom half then being the calculation of the tax and application of the payments and the credits to get down to the tax refund or amount due at the bottom line. We're still going to be up top in the income statement type of format of the income tax equation. This time we're not looking at those above the line deductions, which could be called adjustments to income, but rather the below the line deductions. So when you hear the term below the line deductions, you're thinking of either the greater of either the standard deduction or the itemized deductions. The itemized deductions are what we are going to be concentrating in on here. These are the ones that you're only going to be taking if they add up to something greater than the standard deduction. So we got this kind of default thing on the itemized deductions where we have to think, is this something that's going to be greater than the standard deduction? Because if it's not, it may not be worth our time to be picking up all the itemized deductions. But of course, if it is going to be greater than the standard deduction, then we may want to take the time to add up all the itemized deductions to get the tax benefit related to it. So that's the first thing you want to consider. So when you think about itemizing, then you got to have a feel of the standard deductions that we talked about in a prior presentation. And remember that those will change the level of the standard deduction with regards to the filing status, whether they be married or whether they be single or head of household. There'll be a different kind of standard deduction. So they'll have different thresholds that need to be cleared by the itemized deductions in order for the itemized deductions to be of benefit. And then you got to realize that when you have the itemized deductions that are benefiting, you're really only benefiting from the itemized deductions for the amount of them that is greater than the standard deduction. In other words, when you think about the itemized deductions and you're saying, well, this pushed me over to being able to itemize, you're really only getting a benefit from the difference between the standard deduction and the itemized deductions because you would have got the standard deduction anyways. Once somebody has cleared the itemized deduction threshold, then everything that you can pile on top of that would fit into the itemized deduction category will be beneficial. Usually the thing that clears the threshold for most taxpayers is when they own a home, because on the home you have to typically pay interest on the loan on the home, which could be a big deductible factor. And two, you might be paying state tax related to the property tax, which can also be significant, especially if you're in high cost of living states like California or New York. So if someone has a home, then that's the thing that usually triggers your mind to say, okay, there might be itemizing because they might have interest and then the property taxes and whatnot. And once they are itemizing, then you want to think more closely about these other categories of itemized deductions, because it's likely that any addition from that point, once you're itemizing, can then be beneficial. Now, you can break down the itemized deductions just basically by the categories on the Schedule A. Let's first take a look at the Form 1040. I know this is a little bit small here, but I just want to give you an idea of where it lands in terms of the full 1040. We'll look at it in more depth in a future presentation as we consider this within the tax software. So we're down here on line 12 again, which in the past we've been concentrating in on the standard deduction, but notice of course it said standard or itemized deductions, and you would be taking the itemized if it's over the thresholds, which are here. I know you can't read them here, but you could see them on the tax form, and we'll go over them later. It's $12,400 single, $24,800 if married. So you can see here we've got the $18,580 because we have a single tax filer, and the itemized deductions are over the standard deduction of the $12,400. We'll go into those with more scenarios in the future, in the next presentation in the tax software. And then if you were itemizing, you would be using the Schedule A, the itemized deductions. So the itemized deductions will be categorized, and you could just go over the categories to the left-hand side. Medical and dental expenses, taxes you paid, usually state and local taxes that might be deductible for federal income tax purposes, interest you paid, gifts to charity, casualty and theft losses, other itemized deductions, and that gives us the total itemized deductions adding up to the $18,560. This $18,560 or this line item would have to be bigger than the standard deduction in order to be receiving a benefit. So again, what you typically will be thinking of in terms of tax preparation is, did they itemize last year? If they did, it's likely that they're going to be itemizing this year. If they didn't itemize last year, what are the things that are going to kick them over? When they buy a house, possibly, that might be the thing because of the loan on the house and the interest related to the loan, which could be a significant impact, as well as the tax that would be paid, which would be a state or local tax for the property taxes, which may then be deductible for federal income tax purposes. Those two things will typically oftentimes kick people over the threshold of the standard deduction in order to be itemizing, especially if they live in a high cost of living area like California or New York. So if that's the case, those are typically the things that'll push you over. Then you're going to say, once itemizing, is there anything that we can then benefit from the other categories as well? That's usually how it would kind of, your thought process would kind of go, although other things could obviously kick someone over into the threshold of itemizing as well. But that's a typical kind of scenario, right? Someone's on the standard deduction and then they buy a house possibly, and that might put them over into the itemizing threshold. So then you can go through just basically the line items. We'll take a look at it more closely line by line on the Schedule A in future presentations, but just to review it here, we first have the medical and dental expenses. Now this one can be a little bit confusing because not only is there the threshold to get over the standard deduction, but you also have an AGI threshold that you have to be over 7.5% of the adjusted gross income on your medical expenses before they benefit you at all either. So that's something that many times people will ask about the deductibility of medical expenses, and you have to think, well, first they have to be able to itemize, and second, the medical expenses have to be greater than typically 7.5% of the adjusted gross income. So if they have a high income earner that is itemizing, then they still may not get any benefit from the medical expenses because that high income increases the threshold before any of the medical expenses will be beneficiary, which is kind of good for us because it's easier to do the tax preparation than to try to add up all the medical and dental expenses. That can be a kind of a funny area there. So in any case, then we have the taxes that you paid. Now, when you're talking about taxes paid, if you use tax software, then you're typically going to use software that will be calculating the state tax as well. And the state tax will then help you to be calculated. So the state income tax may be deductible for federal tax purposes, or if the state has sales tax, may be deductible for federal purposes. So when you're thinking about taxes, you're thinking about state and local taxes. The federal taxes are not deductible on the federal tax return because those are the federal taxes. But the state taxes may be deductible for the federal tax return. So that's why we're thinking about things like the state sales tax, possibly the sales tax, possibly the income tax, depending on how the state taxes usually is because you could have a choice of, the state has a choice on how they want to tax people. And then you could have things like property tax, the tax on your licensing for the DMV and that kind of thing are items that could be then beneficial for the taxes you paid. There is no threshold of the bottom line threshold of AGI here. So any taxes you paid could have a benefit, although there may be a cap to them on this side. So if you're in a high state income tax state, like California or New York, then that cap could cause you some problems. And then we have the interest you paid. So when we're talking about interest paid, usually you're mainly thinking about interest on the home loan. So a mortgage interest. That's the big kind of deduction that often kicks people over to the point where they're going to be itemizing. So you'll typically get a form for that. We'll talk more about that in future presentations, but this is usually kind of like the big one. And then you've got the gifts to charity. So the gifts to charity, we'll talk more about them in future presentations, but they have to go to a legitimate charity and whatnot. And again, there's no ground floor either to the interest here, like there is with the medical expenses. You don't have to clear 7.5% of your AGI before it starts to benefit you. Same with the gifts. So if you add up the gifts, once they can itemize, now if they're not itemizing, they now have that $300 above the line deduction that you can get. But if they're itemizing, then you're probably going to be benefiting from having the gifts here on the charitable Schedule A, or if you could do both, but you're probably going to be putting them here on the Schedule A because you have a higher threshold, of course, for the amount that can be gifted here. So that would be here. And again, there's no bottom line threshold. So this is where the gifts traditionally have gone. Although again, if they're not itemizing, you got that $300 above the line gifts as well. And then we've got casualty and theft losses. Now this has been like severely limited. Casualty and theft losses from a federally declared disaster other than net qualified disaster losses. So we'd have to attach form 4684. This, if you're thinking about talking to someone who had some kind of theft or something prior to like 2 years ago, this was a broader category before. They narrowed it down in an attempt to make the tax code easier. It's probably easier for us tax preparers because, you don't have, kind of random things in there. But in any case, other itemized deductions, other from list and instructions. So we'll take a look at the other itemized deductions in a future presentation. And then we have the total itemized deductions, of course, adding up here on line 17. That's the number that needs to be bigger than the standard deduction in order to get a benefit. And notice, of course, you're only getting a benefit by how much bigger it is to the standard deduction. In other words, this is a single filer here. So the standard deduction is the $12,400. So if I say, okay, let's pull out the trusty calculator. We've got the $12,400 that they would have got no matter what without even thinking about itemized deductions. And then if we add up the itemized deductions, they're coming out to $18,560. So minus $18,560, we have a benefit in this case of the $6,160. So, right, because it's the difference between the two. Now, if this was a married couple and they had the $18,560 in itemized deductions still, then it would not have cleared the standard deduction, which would be twice the $12,004 or the $18,008. And so the $24,008. So they wouldn't get any benefit if their itemized deductions only added up to $18,560 and they were married. So you got to have an idea of a sense of what the standard deduction is for married, for different filing statuses, and then think about whether or not they will be itemizing. So if someone was single and then they got married, that's going to be something that you're going to obviously think in your head what happened. If someone was living in an apartment and then they got a home, then that's something that should kind of go, okay, maybe that's going to push them over into itemizing. Big changes like that for tax purposes which make you think and reconsider whether or not they are itemizing this year when maybe they did not in the prior year.